This is a video report analysis of Hibbett Sports as part of Birkenroad Reports, a program of Tulane University A.B. Freeman School of Business. Analysts are Megan Baumgartner, Nathan Joseph, Michael Margolis, Rachel Spirer, and Peter Zumas. We will begin this video report with an overview of the company. Next, we will discuss Hibbett's stock price performance and our valuation. We will conclude with our investment thesis. Hibbett Sports trades on the NASDAQ under the ticker symbol HIBB. The company, which is headquartered in Birmingham, Alabama, is a specialized retailer of sporting goods, merchandise, and apparel. Hibbett operates 892 stores in 31 states throughout the South, Southwest, Midwest, and Mid-Atlantic regions of the United States. Hibbett Sports stores are the company's flagship stores. These stores are approximately 5,000 square feet and offer merchandise from brand names such as Nike and Under Armour. Hibbett Sports stores cater to team sports such as football and soccer rather than individual sports such as hiking and fishing. To solidify a competitive advantage, the company also sells localized athletic merchandise and apparel at Hibbett Sports stores. Hibbett's business strategy is to target underserved, small to mid-sized markets that are not saturated by other sporting goods retailers. Furthermore, another aspect of Hibbett's business strategy is to maintain low operating costs. A low-cost operating structure allows the company to successfully operate in smaller markets where average disposable income is below the national average. Another part of the company's business strategy is its controlled growth. The company primarily follows a clustered expansion growth strategy, which involves opening new Hibbett Sports stores within a 2-hour drive of existing stores. This strategy allows the company to better understand local preferences and also achieve efficiencies in distribution costs and regional management costs. Finally, another component of Hibbett's business strategy is the company's emphasis on customer service. Hibbett works with its vendors to regularly educate employees on new products and technologies. Hibbett also utilizes in-store clinics, DVDs, and training manuals to educate store-level employees about company and industry-related concepts. As of November 8, 2013, Hibbett's common stock is trading at $59.68 per share. Hibbett has nearly 26 million shares of common stock outstanding, and the company's market capitalization is approximately $1.55 billion. Here is a snapshot of Hibbett's stock price performance over the past 5 years. Hibbett's stock price has increased by 304% from $14.77 in November 2008 to its current price of $59.68. This graph indicates that Hibbett's stock price consistently increased from 2009 through 2012 in light of the economic recession. On May 2, 2012, Hibbett's adjusted closing stock price exceeded $60 for the first time and reached a high of $61.10. Since May 2012, Hibbett's adjusted closing stock price has ranged from a low of $50.71 to a high of $62.91. In our evaluation of Hibbett stock, we arrived at a 12-month target price of $60. This target price yields an expected 12-month return of 0.54% from Hibbett's current stock price of $59.68. We assigned Hibbett an investment rating of market perform. We used 2 valuation methods to arrive at our target price: discounted cash flow and relative multiples. In our discounted cash flow valuation, we forecasted Hibbett's cash flows for the next 10 years and an estimate of Hibbett's value after this 10-year period. We incorporated a liquidity risk premium in our discount rate to reflect the premium that investors require for purchasing shares in small companies. Our discounted cash flow valuation yields a target price of $55.16. We also used the relative multiples method, including the price to earnings multiple, the enterprise value to EBITDA multiple, and the enterprise value to EBIT multiple. In arriving at our multiples, we calculated a peer average that included Cabela's Incorporated and Dick's Sporting Goods. The PE multiple yields a target price of $65.18. The EV to EBITDA multiple yields a target price of $59.29, and the EV to EBIT multiple yields a target price of $67.21. Our investment thesis focuses on three main points. First, the expansion of Hibbett's markdown optimization initiative in fiscal year 2014 should increase productivity and efficiency. Next, the company's low debt levels and low operating costs minimize its financial risk. Finally, Hibbett's new distribution center should increase efficiency in inventory allocation and distribution, but the company's transition to the new facility will weigh down fiscal year 2015 EPS by 10 cents. During fiscal 2014, Hibbett intends to expand its markdown optimization initiative across all merchandising categories. The MDO program, which the company launched in Q4 2013, optimizes end-of-season pricing by recognizing differences in regional weather patterns and consumer demand. The MDO program utilizes regional segmentation to divide Hibbett's 890 stores into 4 zones, which enables the company to use zone-level pricing. This pricing technique allows the company to create different, more appropriate markdown schedules for each zone. Although MDO was initially tested on only a few merchandising categories, the initiative yielded positive results for the company. For example, as compared to fiscal year 2012, sales increased by 25% and inventory turnover increased by 20.5%. By applying the program to all merchandising categories, the company hopes to further improve overall efficiency and productivity. A major benefit of Hibbett's capital structure and low-cost structure is the company's low financial risk. Low financial risk decreases the possibility of financial distress and also signifies optimism about the company's ability to continue as a going concern. Rather than borrowing money from lenders, Hibbett finances its expansions with equity. Although Hibbett currently has 2 revolving credit facilities that allow for total borrowings of $80 million, Hibbett has no debt outstanding under either of these facilities. Hibbett's debt-to-equity ratio of 0.25% is far below its peer group average of 6.87%, thus signifying financial stability to investors and other relevant stakeholders. In addition to its capital structure, Hibbett's low-cost structure allows the company to maintain a competitive advantage in its industry. Following tight expense controls enables Hibbett to operate profitably in underserved small to mid-sized markets where household income is below national averages. Hibbett's low-cost structure is evident in a store's startup costs. The initial investment for a Hibbett store is only $200,000, which includes the point-of-sale system, fixtures, and advertising costs. Because of these low startup costs and other expense controls, the company still projects a positive return on investment during the first year of operations. Finally, because of the company's tight expense controls, Hibbett has the highest operating margins among sporting goods retailers, as evidenced in the table provided. The table shows how Hibbett has achieved higher operating margins than its peers over the last 5 years. This metric demonstrates Hibbett's success in creating and capitalizing on cost efficiencies that reflect well on the profitability of the company. In April 2014, Hibbett will transition from its current distribution center in Birmingham, Alabama, to a new distribution facility in Alabaster, Alabama. Unlike the current distribution center, which serves primarily as a flow-through facility, the new distribution center will utilize automated processes and will store 25% of the company's inventories. These upgrades will increase the efficiency of inventory allocation and distribution for the company. Furthermore, at 416,000 square feet, the new distribution center will be almost triple the size of the current facility and will better support Hibbett's store expansion plans. Although the new distribution center will provide a strong foundation for Hibbett's long-term expansion plans, the project will increase Hibbett's cost of goods sold expense in the short term. The company plans on transitioning to the new distribution facility in April 2014, but the lease on the current distribution center does not expire until December 2014. Therefore, the company will incur duplicate overhead costs during this period, which will adversely affect the company's cost of goods sold expense, operating margins, and net profits. Per our discussion with management during our site visit to Hibbett's headquarters, these short-term duplicate costs will weigh down the company's fiscal 2015 EPS by 10 cents. This concludes our video report. Thank you for watching. The Bergen Road Reports are produced solely as a part of an educational program of Tulane University's Freeman School of Business. The reports are not investment advice, and you should not and may not rely on them in making any investment decision. You should consult an investment professional and/or conduct your own primary research regarding any potential investment.